Welcome to Swimming with Allocators,
the VC podcast from the LP perspective,
with your hosts, Alexa Benz
and Ernest Sweat. You ready? Let's dive in. Michael, we've just heard your very relevant background. You've got hedge fund, family office, and now Loyola. Can you tell us any through line, any learnings going from publics to now focusing on privates?
Yeah, I think, probably the biggest through line, obviously being in the LP seat my entire career, it's kind of the only thing I've known. But, you look at kind of the different things I've done at every stage of my career, and it's just kind of a constant building of knowledge and skills. When I started out at the fund of hedge funds, my role was very data and quantitative driven. I think that's been a pretty consistent through line. For better or worse, I always start with what do the numbers tell us? And this isn't, I know we're going to talk about venture, but this is kind of every asset class, because today I'm still looking at hedge funds and public equity funds and private equity funds across the spectrum of venture growth and buyouts. So I'm always curious as to, what sort of data do we have and what can we learn from that, and how does that kind of build and structure our due diligence and our understanding of a manager, and kind of what questions we want to ask, what things we want to monitor. So very, data, a high emphasis on data has been a big part. But, starting out the fund of hedge funds, obviously you're looking at typically, equity or credit driven strategies. These are, different degrees of trading and portfolio construction. And so you learn a lot about, I think, just capital markets from that lens. Was able to later on join a family office that had initially brought me on to support their hedge fund and more liquid exposure. So that included some public equities. But over time, that grew into just anything that was a fund commitment or kind of external commitment. They also did some direct investing. And so, learning new asset classes like buyout and private credit and, real estate was a kind of big part of my earlier time at this family office. And then, more recently, I can't say more recently because it's been 5 years now at Loyola, which is crazy to think about. Crazy in a good way, I should say. But, that gave me the opportunity to take all these different, learnings and experiences and kind of tie them into one and really support, a portfolio that's going through a lot of change and kind of help usher in kind of this new version of the investment office here at Loyola.
That's fascinating. And we've only had, Michael, a few other people who have kind of been allocator lifers, but, jumping in a lot of different seats. And I could pull a thread on that. But I think one question I want to talk about is just like, what's kept you there from this side of the table? And what keeps you interested in making fund investments?
It's just, how dynamic it can be. And again, I'm speaking from a seat of a generalist, essentially. And, we're a smaller team here at Loyola. It's 4 total. And so everyone's got to participate and join in on calls across different asset classes, different parts of the market, different geographies. And so you get a very broad exposure to, the world and capital markets and how different businesses work. And, you get to speak with some pretty intelligent people who are subject matter experts, right? And you get to hear from them why they think, why they do what they do, why they think their particular strategy or area of focus is interesting. And you can, if you want to, you can meet someone new every day and hopefully learn something every day. Maybe I'm not learning something new every day, but there's certainly no shortage of just knowledge out there that I am, lucky enough to have access to, or to the most part get access to. And I think just for me specifically, like I've really been fortunate to work with some awesome firms, some really cool people, have bosses that cared a lot about my career and kind of my path forward and how I developed and that keeps you there, right? I think the subject matter's very interesting. I've had the benefit of evolving and kind of broadening my horizons when it comes to different asset classes. And along the way, I've worked with some really cool people that have been supportive and really cared about my career. So that's been a big part of my experience as an allocator.
Mike, is there a advantage that you see today from all of your time as a generalist in the different asset classes? Like obviously, our show mostly the audience is centered around venture and growth equity. Um, is there anything by seeing kind of what you see in hedge funds and maybe private equity, lower middle market, other areas, credit, that has helped you with developing a thesis or see trends earlier in venture and growth?
I think it's just knowing that there's more to life than one asset class. It's interesting because when I went from the fund of funds to the family office, I maybe naively was just very much focused on the hedge fund can solve a lot of problems in a portfolio, and and that's wrong. It's flat out it's wrong. There's a lot of other factors that go into what a portfolio needs, whether it's a broadly diversified hedge fund portfolio, or it's a family office, or it's an endowment. There's uh, different LP types have different needs, and so using kind of one asset class to solve that is not efficient. Frankly, it took me a while to kind of get over that hump. I think there was a lot of conversations I remember having working at this family office and saying, "Oh, I think there's a really interesting hedge fund strategy. They do this and that," um, and the family would be like, "Well, why do we need it? Like if they're doing long short equity, why don't you just be long equity?" I don't know. It's things like that. And I think that's been that was an eye-opening experience. And as time's gone on, you kind of realize that there's many different ways to build a portfolio and a lot of different ways you can structure it based on kind of the constraints of the stakeholder base that you're allocating on behalf of. And then the other piece too, I think the benefit of being a generalist is you can kind of understand the other side of an opportunity. Just as a maybe generic example, when I speak to, and this goes both ways, when I speak to a buyout fund that's investing in, some sort of industrial company, and say they're manufacturing widgets, and they say, "Oh, that's interesting." They think they have a better way of making these widgets cheaper and expanding distribution. But I also then hear from a venture capital fund that they're investing in a company that is coming up with a way to make those widgets without people, with using different materials. Again, this is a very broad and generic example, but you can kind of go to both of them and say, what's the risk? What's the opportunity? Do you know about this company that's coming up with a new way? You venture capitalists, do you understand that there's these incumbents that are doing things and have the distribution and have the financial backing, that's kind of what you're going up against? And you can kind of play that knowledge off of each other. You see that also in kind of the private credit markets, private credit versus more buyout strategies. And you see buyout funds kind of telling me one thing about the terms they're getting and from lenders, and lenders telling me one thing about the terms they're getting with these sponsors, and sometimes they don't often line up. And so you can build a maybe more honest picture of what's going on in a particular asset class, which you know should work to our benefit. And then last, it's just kind of risk reward. I think you understand. It's interesting because I worked in hedge funds during a kind of coming out of a period of time where hedge funds were very popular and saw a lot of asset growth. And then kind of post GFC, interest rates low, hedge funds maybe not the most compelling thing or interesting thing to do. And a lot of that interest moved over to private markets. And I think you're kind of seeing that flip. a little bit. Hedge funds seem to be, at least in my circles, getting a little bit more attention. I don't have to tell you two, but issues with liquidity in private markets, I think is starting to have a real impact. So, things can, these trends are never permanent. And so being a generalist, you're able to kind of move, slowly in and out of things as you see fit.
I want to know if you agree with that shift. You're seeing this trend where like money's leaving money's leaving the private practice a little bit and heading back into hedge funds. And are you feeling that draw?
Um, so I guess I'll caveat this answer because we're in a little bit of a different position in that our private capital allocation has grown, and so we're kind of filling that delta. Whereas our hedge fund allocation has remained stable. So us, Loyola, haven't seen a large, migration of hedge funds to private equity and vice versa. Um, but I, I, I'm a part of a lot of different LP conversations, and I'd say when folks look at, where does the incremental dollar go, it's becoming tougher to maybe justify doing another private equity fund, especially if they're not seeing the distributions. Venture obviously is a longer hold period, and it's even longer than probably folks initially expected. And you look at hedge fund strategies, and this has also coincided with the real emergence and I think domination of multi-strat hedge funds that have offered good returns at low correlation and low beta, and so it's these all-weather strategies that perform quite well, and that's been a big draw. And I think similar to how you see in some private markets where bigger firms kind of account for a lot of the fundraising, you see a similar thing happening on the hedge fund side. But that's, I think that's also, there's when you look at who's coming out and launching new hedge funds, it's folks spinning out of these larger platforms that want to kind of do what their narrow sleeve was, just individually. And those are getting a lot of attention because they have the pedigree, they understand risk management, they have some sort of track record that they can point to. And so for an LP that wants to do hedge funds, it's something you can viably see as an interesting alternative in your portfolio. But yeah, we're not feeling that pull right now. But we've been certainly in our hedge fund portfolio, we've been looking at ways to exploit just other inefficient markets, whether it's emerging market credit or even kind of the up and down, kind of the energy cap stack, looking at ways to play that market. So
Mike, when we had the prep conversation, you spoke a little about before or when joining Loyola, it was an opportunity to kind of build from scratch. And we have a number of allocators that reach out to us or that have been on the podcast that have faced this situation based on the changing of these pendulum swings, right? And the one that you were mentioning just a minute ago, I'm confident it's going to happen again when this IPO market opens up again. So could you just speak to what that experience looked like from the outside and kind of like learnings from like when you do have kind of a blank slate or we're going to change the strategy, how to approach that as an allocator?
yeah. I mean, I think for us, our situation was really a meaningful increase in the private capital allocation. So historically, it was around 10%, and our investment committee decided to double it to 20, and this was right around when our current CIO had joined, and along with that change in allocation was also just kind of the remit to go and for our CIO to kind of figure out how to do that and what she wanted to do and how she wanted to approach it. And so, both her and I came from backgrounds where most of our private capital experience was either in the buyout space or on the credit side. Neither of us really spent much time in venture. I think we both had, within buyouts, had a kind of an affinity for lower middle market buyout. So that was, a place that we knew that we were going to spend time, but wanted to really, utilize the full extent of, what it means to be an endowment and have a really long investment horizon. And, venture should be on the table. But I think what we were cognizant of, and this is, both us, but also the support of our committee kind of telling us, you don't need to rush into doing this. Like, again, we have such a long, this is a perpetual investment vehicle. And so don't feel like you need to get us from 10% to 20% in 2 years. As a matter of fact, that's probably the wrong way to do it. These is you both know, like, markets are going to ebb and flow, and the important thing, I think, is to just be consistently participating in private markets. You're never going to be able to time the right vintage, and the thing that you learn too as you commit to these funds is there's the vintage year, and then there's when they invest the years that they invest the capital. And sometimes that vintage year isn't the best representation of when they deployed most of the capital. And so, we went in it with a pretty, I'd say, conservative budget, knowing that we would take our time growing into this allocation. We started with looking at the buyout space because, again, that's what we knew.
I would love to hear the story of those early days of sort of getting your feet wet in venture, like taking those initial pitches. What's that story like?
Yeah, it's you kind of go where you think you should start, which is who, even though, like, you have access to a lot of research and newsletters and anything, you can kind of derive kind of who are some bigger players in the venture landscape, and you start there. Again, like the LP network, and just leaning on some folks that we knew to give us some ideas and just talk about where to start, I think was really helpful. But that it's also, there's also kind of this unique factor of when we started, being in kind of late 2021 and early 2022, and having these conversations with GPs that it was just a hot fundraising environment, both for the managers and for underlying companies. And you would have a conversation with a firm that everyone would recognize, and they'd say, hey, well, can you get your work done in a month? And can you commit to our suite of funds? And, at your check size, we need you to really basically triple it for it to work. That's a little bit unique to us because, at our size, we're like a $3 or $4 million commitment into funds. And a lot of these groups are like, we need your entire budget for the year to make it work. Again, it goes back to, like, not feeling forced to make these commitments and press, the gas pedal down on the venture side too quickly. And so we said no, and took our time, and, through our network, got introduced to folks that kind of led us to this side of the market on the smaller and emerging manager side, and have learned a lot.
Now we're going to take a quick break to speak with our sponsor.
Getting going on your institutional fundraise. What advice would you have for GPs who are preparing for their first institutional fundraise?
Really, they should focus on a few key areas. And I think one is the operational infrastructure. Like, think about how you're going to run the business, right? How is this going to work? How are you going to identify opportunities? How are you going to deploy capital? If this is your first time as this organization running a pooled investment vehicle, and so LP capital calls, working with an administrator, what does the infrastructure look like, right? Who's doing what? And that sounds very basic. And from a regulatory perspective, why do I care about this? Because it flows into the disclosure, right? So your disclosure framework and the disclosure discipline is going to address your anti-fraud principles, right? So what you say to your investors and how you say it is wrapped around this idea of the way in which the Advisors Act and the requirements for advisors fit with an exempt reporting advisor, which is anti-fraud and fiduciary principles, which come back to disclosures, right? So you have your qualified purchasers, accredited investors. You've got sophisticated folks who you'll be working with as your LPs coming into that vehicle. What you owe them is that transparency and disclosure. And so, what are you going to say about what you're doing? And it's hard to tell that story in a way that will hang together, be transparent, and I would say both comprehensive and coherent. If you haven't thought through how you're going to do that, right? And so I think that's where, when we run into folks who've kind of gotten a little sideways, it's because they didn't really think about the fact that they're running a business, right? They're making investments, and they're very good at making investments. Maybe they've done it somewhere else. Maybe they're breaking into the space, and they want to get out there. They want to find those opportunities to invest. They want to get that capital in. They want to be the first one in the door, right? So they're really focused on, raise the money and make the investment, get the capital in the marketplace, and the investment side of things. The rest of the business that happens around it is where a lot of the conflicts come up, right? And so I think spending that time, which allocating time, the most limited resource we have, to what is basically a conversation about, okay, well, who's going to turn off the lights when we walk out the door? That can be, it can feel like a distraction. It can feel like it's something that in the moment isn't worth the time. But if you fast forward, it is absolutely worth the time in order to frame the conversation the way that it will be best received by your LPs if you've thought through what disclosures you have to make.
Yeah. Are there any disclosures that you see sort of becoming more popular or more just sort of more expected?
Yeah, I mean, I think in that sense, it really comes back to those conflicts of interest, and the details around the manager's governance of a conflicts of interest framework. So there are a number of different ways that you might run into conflicts, both in terms of what the manager's business is, where you may have other activities of the advisor. That could be with portfolio companies, could be the manager's involvement in the portfolio company, it can be across portfolio companies. A lot of different ways conflicts can arise. It's innumerable ways, in ways that you won't foresee. And so how do you deal with something that you don't know what's going to happen? You come up with a framework for dealing with it, right? And that's that governance framework for dealing with conflicts. And so coming up with the disclosure that describes how you're going to identify, mitigate, or eliminate and disclose conflicts, like that framework is where we're seeing a little bit, I would say we're spending more time developing that narrative of how folks are going to deal with that. Because the things you aren't able to perceive today, tomorrow's problem that you don't yet know about, if you have that framework and have provided that disclosure, you can come back to that. Hey, remember we told you when things come up, we're going to deal with them this way. Well, something's come up and we're starting to deal with it. And here's where we are in the process. And we've already told you it's going to go through these, 5 steps, 7 steps, 9 steps. And we're at step 2, but we're letting you know that that's what we're doing, right? And so having that descriptive governance frame, that description of the governance framework, I think is something that again, more time being spent there and putting that together.
Oh, thank you so much, Chuck. I can see why you've been described as the Elvis of the legal regulatory community. Is there any final passing thoughts on what you would like our audience to know about Sidley?
I would just say that it's a great team. I work with Shane in the VC space quite a bit. He's incredibly knowledgeable as well, and he's just part of the team, as I am just part of the team. It really is the Sidley team, and that's, I think, what makes us very good at what we do. I like to think that we're the best at what we do. That comes from the depth of the team, whether that's types of businesses, so through the experience of different M&A teams and acquisitions, different corporate teams, tax, different LP types, ERISA, you name the specialty need, and we have someone here who is an expert in that. And so that's what makes it a lot of fun for me to be here, is I get to talk to really smart people all day and think about very novel and complex issues. And our clients bring us those because we've got that deep bench and expertise across the board.
Thank you so much. And now back to our LP interview.
Is there one mistake during that period or faux pas that you was like very critical in your viewpoint now and that you'd like to share with the other allocators to make sure they miss?
No, it's one of those where I think just not being familiar with just the speed. It's, you kind of say, hey, like, we're interested, and maybe that's interpreted as I can move quickly, and that does, again, we're a small team, and we're trying to do all this on our own, and so the diligence timeline can be a little bit lengthier than maybe what they expected. And so, it's, and I don't know if this is where GPs, just again, through their lens of working with founders, you make an investment on the best available information in the period of time that you have. And, for us, like, I think we feel more comfortable saying no, and just building a relationship. But yeah, I think I've learned just to kind of, with every interaction you have with any fund manager across asset classes, just continuing to be very upfront and transparent with kind of what you think and what your ability is to do work, and what your interest levels are, because everyone says it, but a quick no is really valuable. So we try to do our best to get those quick no's back to GPs when we can.
One of the things that you had mentioned that was an aha for me too was not falling in love with track record. And I'd love for you to share why that performance data for early stage venture for you've realized can be a little misleading.
Yeah, I think like well, I think there's a lot of caveats. There's a lot of nuances that come with a track record, especially in venture. I think, the first, and that's always kind of a pet peeve of mine, is when someone says we were a top decile, 2022 or 2023 vintage, and it sounds great, but I don't know if much has happened, right? To say, like, maybe you've had a couple of markups, but it doesn't really tell you a full picture. And I think the thing with venture that we've had to get used to is that understanding that you don't really know what you got from a performance perspective for several years. There's an interesting stat with buyout funds where you see that the TVPI of a fund pretty much peaks around year 7 or 8. And from there, it can maybe go down a little bit, go up a little bit, but you kind of know where the fund's going to end up at that point. For a venture fund, by year 7 or 8, like, that's maybe when you're starting to really see like value creation accrue to the fund, whether it's exits or substantial markups. We kind of had this conversation internally recently where we were looking at a track record for one of our VCs and saying, oh, like, there's actually, this isn't kind of the case. I'll kind of rephrase this, but we looked at the numbers, and kind of concluded that it's not like we shouldn't expect that this is the final performance number of the fund for the rest of our holding. Obviously, the IRR can change with just distributions and timing, but yeah, just knowing that you can look at these these funds, and a lot of the performance data is based on marks that may or may not be warranted, especially when you're looking at pre-seed and seed. You could have a nice markup at the Series A, but that doesn't mean the company is going to be around in 5 years. I think the stat is over a third of companies that raise a Series A still fail. So you don't know what you have, and especially when it's only a couple years after you commit, you really don't know what you have. And even looking at, we try to look at fundamental underlying portfolio company operating metrics, and that might tell you a different story, and could be one of growth. But again, like if companies are still, very early in their life, there might not be revenue to speak of. They're still building or what have you. So yeah, we try not to get too tethered to what that performance number looks like. And I think too, kind of mentioning a little bit on like how deployment and how we're committing capital, and then how the GPs are deploying that capital, looking at things on a vintage year by vintage year basis, don't maybe tell the best story. We try to look at it at a deal by deal basis or a year by year basis if they're more of a high volume venture investor, or have a longer track record where we can say how have they deployed capital year over year, and how have just those annual cohorts performed. Because again, like we've seen situations where if it's call it a 2025 vintage because they did one deal and they called capital, but the rest of the money is being deployed in 26 and 27. And so like really what's the best benchmark for that? So it's tricky and it's nuanced, and you have to kind of look at it a few different ways.
Digging deeper in that nuance, what are questions or tactics that you try to employ to get more of that data on projecting the success of this fund manager? Do you have any favorite questions or approaches?
Well, I think it's kind of going through their portfolio, and maybe if they have reserves, where have they doubled down, and kind of understanding what their math is there. I think it's one of the newer learnings that I've encountered in my venture capital experience is this concept of reserves and what's the right amount, and is there a right amount for smaller funds versus bigger funds. And I'm sure we've all seen the LinkedIn post from people saying if it's a smaller fund, don't use reserves. And I tend to buy that a little bit. I think there's especially if you have a 3-year investment period where first deal might be coming back for their next round, and you're still deploying into other first investments. And so how do you judge, is it worth putting capital here versus something new? But yeah, for us, when we look at, how they've deployed capital, it's a little bit more about, the decisions they make when they are able to invest more, and whether they do or not. Like when it's looking at the investment performance, it's all about, I think for early stage venture, it's, how did you build that portfolio versus kind of how it's done. I think seeing markups is great, and having really strong co-investors is a good signal. But we're curious to know, like, how are these companies growing? Are they doing so in a kind of capital efficient manner? Is this something that's going to be capital intensive down the line and maybe dilutes our ownership? And so it's very situational dependent, but yeah, always kind of, especially in those early days, what the milestones are these founders, these companies hitting, and is that kind of on plan, off plan? That gives you a good sense of maybe how performance is going to look down the road.
And since getting started, this is you're 5 years in. Started initially with a fund of funds, a great place to learn. Are you actively vetting managers now? And what's the sweet spot for Loyola?
Yeah, so I'd say we're trying to emphasize primary commitments. We're really happy with our fund to fund partner, and he's been super supportive of how we go about building our portfolio, and really trying to, our goal is to have most of the commitments through kind of directly into funds. Um, and so, our process, I'd say it's a bit of a barbell. We do definitely emphasize that cohort of smaller and emerging managers. I'd say emerging managers is something that across the portfolio, even outside of private capital, we emphasize here at Loyola. I think there's a lot. There's obviously there's been a ton written about the benefits of backing managers early from a performance perspective and backing folks that are smaller. But yeah, I think those things resonate with us, but also I think it's the relationship that we build. I think it's just, again, like, we're not going to be your biggest LP, assuming that, I think our kind of minimum fund size is, call it, around 30 million. But you know, we're never going to be that really chunky LP for you, but hopefully we can be an LP that understands what you do and how you do it, and ask good questions, and um, be supportive for multiple fund vintages. But so anyway, so that's really drawn us to that smaller and emerging manager segment. But there's, I think, funds that are a bit larger that do interesting things as well. And so you look at our portfolio and you'll see a handful of names that are, call it, a 150 million to 250 million dollar fund, and they're kind of deploying a different playbook. Obviously, they're trying to lead deals. They're really going for high ownership. Maybe these firms have bigger teams, so they approach sourcing with maybe more of a research-driven thematic lens than network-driven. But it all kind of comes down to, what is that portfolio, fund model look like, and what sort of assumptions need to be made to generate a good venture return. Which for us, we think table stakes 3x, but I think people would probably laugh at that. We want to see GPs that have a really robust network, because at the end of the day, it's about access. And again, we're focused primarily on early stage, so pre-seed and seed strategies. Maybe they'll start at the Series A. And so access is key. The common refrain of see, pick, win. I think you gotta see them first, and having an appropriate network to see the right deals for you as an investor, and interesting founders is very important. So we want to see that there's something there that has some durability to it, whether it's you got a network of other investors, you were a former operator, and so you have a founder network, and or you just just it's a broad, robust pool of people that you can tap into and see interesting companies and get warm introductions. So you can't tease all that out from a pitch deck. I think everyone kind of puts their best foot forward when it comes to what their network looks like, and where they see deals. But through conversations and references, you can really tease that out. So trying to lean towards smaller emerging managers. The fund size kind of makes sense for the strategy, and you have to kind of have a compelling reason to access good deals.
A lot is going on in the world today, which I think is an understatement of the century. But with respects to endowments and smaller endowments, could you, help our audience of emerging managers understand, when partnering with a smaller endowment, what the advantages are? What do you believe the advantages are, and how they fit within the LP stack today?
Yeah, well, I think there's a lot of advantages from our side of the table, being the allocator, right? Just access to strategies that I think are inherently a little bit more interesting. Those smaller funds that can, whether it's buyout and you're looking at small companies, it's a very inefficient part of the market. If you're investing in a small cap public equity manager or a micro cap public equity manager, where that's a super inefficient place to find deals and interesting companies, and you can do that. And when you get too big, you kind of have to move outside that sweet spot, and without, so you don't impact liquidity. And so us not having to write huge checks, we can find these interesting funds, interesting strategies, and make it a meaningful part of our portfolio. I'd say too, not always the case, but it's oftentimes been the case where we speak with the GP that I think is very popular, and the fundraise is going to be pretty tight and clean. And they ask us, "What's your check?" And I say, "Oh, maybe we'll do 3 or 4 million," and you kind of see a little bit of relief come over them because say, "Oh, that's not that bad. We can find room for that." Again, it's not always the case. We've certainly been told no before, but being able to sneak in to some funds is an advantage. I'd say kind of flipping it around to the GP, having an endowment or having LPs that are kind of serving a higher purpose. So for us, it's education, and it's providing the best climate and environment and resources for the students at Loyola. I think that means a lot. It means a lot for us. Hopefully, it means a lot for them. And so them doing well allows us to generate good returns is helpful in that effort. But I think the thing I'd say is despite us being a smaller endowment, we still have the same requests of GPs as everyone else. We want transparency. We want access to the team or the manager, and it's got to be timely. It's got to be somewhat detailed. I don't think you can get by in today's allocate or fund world that without really giving LPs something. Even if you have a great track record, I know that they can be a little bit guarded with their portfolio data, but it doesn't have to be something you send out every quarter. It can be a conversation that you have. Just access is important. And so we're never gonna kind of let managers kind of relax when it comes to transparency, because we need to know, because we need to report to our committee, who reports to the broader board of the university, and so it's important to know what we own. And just because we're a smaller check doesn't mean we shouldn't have access to that. Not saying we've run into that situation or that issue much, but I think it's always important to say.
Final thoughts, any advice for other smaller endowments, foundations, or family offices that are just getting started on their venture program?
Yeah, I think take your time. These investments take a long time to play out, and you can definitely get caught up in just kind of the whirlwind of GP introductions and people pitching you on your fund. I mean, it's still there's no shortage of early stage venture capital funds, which I'm not saying is a bad thing, but I could spend most of my time speaking to managers, and a lot of folks seem sharp and interesting and have a value proposition that's compelling, and but you can't do it. You can't invest in all these things, and you can't, and you shouldn't do it all right away. And so taking your time, having I think a strict commitment budget helps. We every year we come in with, this is how much we can commit to venture, how much we can commit to buyout, and that's kind of good to have those guardrails, because we don't want to see ourselves going too far. If we miss it to the if we're kind of short, that's maybe not the worst, but if we're way over, then that could be a bit of concern. So I'd say take your time, have a good strict commitment budget, and make sure that you're kind of in the market consistently. If you're looking at emerging managers or you want to do emerging managers, I think screening on performance is probably not the best method. I think leaning on your network and talking to people, maybe not like me. I mean, we're still new at it, but we might have some insider input. But leaning on other LPs that have been doing venture for longer is a great place to just pick up, some interesting names and bounce ideas off of folks and kind of increase the throughput on your pipeline. And depending on your team size, like us, like I think a fund of funds isn't a terrible idea.
Yeah.
It's I think in venture, fund of funds can generate good returns. And if you find the right partner, I think they can be very value additive to your process. And so if you do decide to invest with a fund of funds, make sure you leverage that relationship to the best of your ability, because you can really, again, like it's good kind of foundation building for your broader venture program.
Mike,
Thank you so much.
thanks, Mike, for being on. Really appreciate your honesty and just like your thorough approach. Thanks for being on.
Thank you. No, I appreciate you having me. This was fun.
See you later, allocator.
After Portfolio Tile, investing with a smile.